how to invest in 2019.
There you go.
Good, because 2018 just needs to go away.
Indeed.
How do we invest and make money in 2019 in this kind of market?
Multi-asset class. You need high-quality income-producing assets. Should be a large part of a portfolio. And our asset allocation.
Is that a bond? What is
that?
You don't need that thing. It's just
quality fixed income. So you think about this. A fully invested portfolio that's multi-asset class that has everything is 39% equities. When you have a drawdown of 10% and you're at 39% in your equity allocation, it's not the same thing as being 100%. This idea of getting in and out of the market fast, we think is a mistake. You tend to see the largest declines and the largest gains right close together, and it's usually very self-defeating. You have to be in the market to earn dividend income, to grow it over time. But now we think there's a lot bigger waiting for portfolios, and there should be much more value and high-quality fixed income for U.S. clients.
Over equities.
No, it's not over equities. I think it's, in this case, both. We think that we are, at this point right now, we are overshooting to the downside in markets. There's been much more of a decline than we see prospectively in the economy going forward. So just think about it this year. For the S&P 500, you've had about a 25% valuation contraction. But it's late in the cycle. The Federal Reserve is tightening. We think that earnings will make another record in 2019. Got to remember, this is a record earnings year in 2018. But there's still going to be valuation constraints.
And with all due respect to a lot of the great men and women who appear on this fine network, who talk about how, you don't need that, just flip it back. It's just you and I. There you go.
There you go.
Who talk about how valuations are now more attractive. In late cycle investing, in higher interest rate investing, shouldn't valuations contract? Aren't they supposed to contract?
No, that's right.
And it doesn't mean they have to uncontract and, in other words, the market go back up. That's not the way it always works.
Let's look at it this way. When the U.S. economy is in recession and earnings fall 25%, and it is a question of when, we've had this a dozen times since World War II, you'll get share prices down somewhat more than that. We do not think 2019 is that year. And we do think that, again, we're going to make another new record high in profits in 2019. And I even think that the earnings estimates that we have right now for the next 2 quarters have already been cut too much. But what we did see in 2018, with valuations contracting, right, in the face of tighter monetary policy, is going to be with us again in 2019, unless the economy does falter. So in some ways, monetary policy, and as we think about the Federal Reserve meeting this week, tightening into an unfriendly news environment. You don't have the can't lose kind of monetary policy we had years ago, where no matter how fast the U.S. economy grew, we ended up with easy monetary policy. This is an environment now where the Federal Reserve has to be stopped.
Riskier. It's a lot more risky right now, isn't it? For a lot of reasons.
Right. So what happens again is that the Federal Reserve would stop tightening. Monetary policy will be negotiable if the economy falters. And again, if it doesn't falter, then you end up with tighter monetary policy and the same sort of issue that limits returns. But there's still, I think, very good opportunities investing across multiple assets right now.